Welcome to this explainer. Look, if you've been watching the housing market lately, constantly checking prices, sweating over mortgage rates, you're probably feeling confused, frustrated, or maybe even a little panicked. And honestly, you are absolutely not alone. Today, we're dissecting some major new data from Morgan Stanley and Harvard University to figure out what the heck is actually going on out there. So let's just jump right in and address the massive elephant in the room. Is the 2008 style housing crash we've all been waiting for actually canceled? For the last couple of years, so many prospective buyers have just been holding their breath, right? Kind of banking on the idea that what goes up must come down and a massive correction is just right around the corner. Well, most people are sitting on the sidelines expecting a total collapse. But Morgan Stanley just came out with a really stark warning. They're saying, actually, scratch that. We aren't heading for a crash at all. Instead, we are entering a permanent market reset, meaning affordability might literally never recover to the levels we saw just a few years ago. The crash everyone is waiting for might not ever happen. And by the time folks realize it, the window to buy might already be completely shut. All right, Section 1, the housing market reset. Okay, get this. Despite all the economic pressures and all the doom and gloom predictions of a downturn, the median home price in the U.S. just hit $429,000. And shockingly, it is still climbing. It's up another 1.3% from a year ago. Prices are just stubbornly pushing upward, completely defying everyone's expectations of a cooling market. And ouch, here is where the real pain sets in for prospective buyers. 30-year mortgage rates, they're still sitting right around 6.5%. So we are getting hit with this brutal dual squeeze, near record high home prices smashing right into high borrowing costs. But it begs the question, if homes are so unaffordable, why aren't the prices dropping to meet the buyers? Which brings us to Section 2, the mortgage lock-in effect. To understand this, we really have to look at human behavior and who actually holds the mortgages right now. A whopping 70% of current homeowners have rates below 5%. And half of all mortgage holders, they are actually locked in at a rate below 4%. This creates what Morgan Stanley calls a severe lock-in effect. It's basically like financial golden handcuffs. Think about it. There is absolutely zero financial incentive to give up a sub 4% mortgage, sell your house, and go buy a new one where the interest costs you 50% more. People are practically chained to their current homes. And honestly, can you blame them? I wouldn't move either. Because literally nobody wants to move, housing turnover has hit a 40-year low. It's been completely flat for 11 straight quarters. It's this bizarre paradox right now. We have weak buyer demand because homes are so incredibly unaffordable, but that is completely canceled out by an equally weak supply of homes actually for sale. They just neutralize each other and the entire market freezes in place. Moving right along to Section 3, the post-World War II housing illusion. This frozen market leads to a fascinating point from Harvard researchers. They suggest that the normal market we keep waiting to return to, well, it might have actually been a total anomaly. Right after World War II, 16 million veterans came home, and the government engineered this massive housing boom to absorb them into civilian life. It was a perfect storm. You had government-backed cheap debt through the GI Bill, crazy amounts of cheap land, rapid construction, and rising wages. It is what made widespread homeownership possible in the first place. But fast forward to today, and our market is the exact opposite. Today, we are dealing with super tight zoning laws, sluggish construction, skyrocketing insurance premiums, high interest rates, and wages that haven't even come close to keeping pace with property prices. The exact conditions that built the American housing dream have practically vanished. And Harvard neutrally points out a pretty profound societal shift here. They suggest our system is moving away from purely income-based access, where you just work hard and save up, toward a system that is heavily dependent on existing family assets. Basically, getting into the housing market today often relies more on whether your family already owns property to help you out, rather than just your own paycheck. It's a fundamental rewrite of how home ownership actually functions in our society. So, what does this all mean for us? Section 4, 5 predictions for the future. Based on all this data, here is exactly what Morgan Stanley predicts happens next. First up, prices stay high. There is just not enough supply for a collapse. Second, we hit a new equilibrium where buyers eventually just get used to these higher rates, feeling normal. Third, a massive surge in rentals because folks are locked out of buying.
Fourth, persistent supply problems, because even if rates do drop, land and construction costs definitely won't. And finally, a chain reaction. This frozen housing market ends up slowing down the broader economy because, people aren't buying couches or hiring moving companies. And look, it's not just Morgan Stanley saying this. The consensus across other major institutions is incredibly consistent. Zillow sees a few dips in highly constrained areas, but rising prices on the East Coast. Realtor.com is projecting that average homes could hit $1 million in 25 years. CoreLogic expects national prices to go up 5.1% year over year. And Fannie Mae, they're looking at a 13.6% rise by 2030. Analysts across the board are forecasting flat or increasing prices, for sure, not a collapse.
All right, let's bring it down to the micro level. Section 5, your housing action plan. Given this new paradigm, the absolute first rule is this. You've got to stop letting the fear of missing out or the hope of a massive crash run your life. If you are sitting on the sidelines waiting for a 30% discount that institutional data says is likely never coming, you are literally putting your financial life on hold for a ghost. So here's the strategy, and it's actually pretty simple. You should only buy if the monthly numbers comfortably work for your current income, you have a solid emergency fund, and you plan to stay put for a 7 to 10-year timeline. If you can't check those boxes, there is absolutely zero shame in renting. Seriously, if renting is significantly cheaper in your local area and you are disciplined enough to strategically invest the difference in the stock market or other assets, renting can actually be the mathematically superior choice. For decades, society has pushed buying a house at all costs. We've all heard it, right? Renting is just throwing money away. But as this explainer shows, those old rules just don't perfectly apply anymore. Tying up your entire down payment in an illiquid asset when rates and prices are this sky high is not the only path to financial freedom in 2024. Your checking, savings, and investment accounts can and absolutely should be actively put to work. So I will leave you with this final thought. If the post-World War II housing dream was just a one-time historical exception, and the market has permanently reset to a much more expensive normal, how will you rewrite your own financial strategy for the future? Are you going to adapt to the new rules, or keep waiting for the old ones to return? Thanks for exploring this data with me today, and keep learning.